Okay, so let's continue to talk about introducing the Federal Reserve and the interest rate that the Federal Reserve controls. When we say the Federal Reserve controls the interest rate, specifically, we're talking about what is called the federal funds rate. Um, the federal funds rate is the rate at which banks borrow from each other overnight. Um, each night when the banks close, they need to make sure that they have their reserves at the Federal Reserve to meet their reserve requirements, right? So when they shut down at night, stuff's going down during the business day. You can't check in the middle of the business day if you have reserve requirements because the amount of deposits is changing the amount of reserves requirements. So when they shut down at night, then the Federal Reserve checks, do you have the required reserve requirements? So they just need to have the appropriate amount of reserves while they're closed overnight. And so the banks that don't have enough reserves when they shut, right, they make a bunch of loans, they take in deposits, then they check at the end of the night, do we have enough reserves? And some will not have enough reserves. And so they're going to borrow from other banks that find that we have excess reserves. And the interest rate that they do that at is called the federal funds rate. Since this is a really short term interest rate, they're just borrowing overnight. And banks are really safe. It's very unlikely that bank is going to go bankrupt overnight. This is one of the lowest interest rates in the entire economy. And other interest rates rise and fall with that rate. So if you look at your credit card statement, it'll probably say something like the interest on this credit card rate is like 18% above the federal funds rate. So as the federal funds rate goes up, your credit card rate goes up. Not all rates are a fixed amount difference. The difference between short-term interest rates and long-term interest rates is called the spread, and that spread changes with the other parts of the economy. But in general, when the federal funds rate goes up, other interest rates go up. When the federal fund rate go down, other interest rates go down. So let's say the Federal Reserve wants to increase the federal funds rate. How do they do this? Right? To increase the federal funds rate, it needs to remove reserves from the system to decrease the supply of these reserves, right? So they want to decrease the supply. That's going to cause the cost of these reserves to go up. That is to cause the interest rate to go up. So what the Federal Reserve will do is that they'll start selling bonds to the banks. They'll conduct an auction of the Federal Reserve owns a lot of government bonds, and they'll conduct an auction. This is run out of the New York Federal Reserve Bank, where they will, hey, we have these bonds for sale. What bank wants to buy them? The bank that buys, willing to offer the highest price for the bonds buys the bonds. And so it's going to be a bank with excess reserves that buys the bonds, right? So they're going to be using those excess reserves to buy the bonds. And in so doing so, they're using those excess reserves to buy the bonds. They're not going to be lending them out. So that's going to be decreasing the supply of these reserves in the system. So when the banks buy the bonds, the Federal Reserve, they just simply go into their spreadsheet, right? It's not like they need to carry actual cash over to the Federal Reserve. Now, the Federal Reserve has a spreadsheet that says this is how much each bank has on reserve with us. And when they buy the bonds, the Federal Reserve just goes into that spreadsheet. And, if a bank buys $100 million worth of bonds, they go into that bank's account in the spreadsheet and subtract $100 million from it. When they're doing this, they're effectively destroying money. There used to be $100 million more dollars in the economy, and those $100 million are now gone. They just disappear. The Federal Reserve just destroyed the money. How would they do it if they wanted to lower the interest rate, right? If they want to lower the federal funds rate, in that case, they want to increase the supply of excess reserves. They increase the supply of excess reserves, right? There's more competition of banks trying to lend out their excess reserves. It'll cause that interest rate to fall. So they buy the bonds from banks. The banks own a bunch of bonds, and now the Federal Reserve buys those bonds from the bank. When they buy those bonds, they don't need to have cash on hand. They don't need to take the cash to the bank, right? They just simply go into their spreadsheet that says how much that bank has on credit with them. And, if the bank is selling them $100 million worth of bonds, they just add $100 million in their spreadsheet of that bank's reserves, right? And so in doing so, the Federal Reserve is creating money, right? So that's all how it works under normal times. The past decade has been weird time. So in addition, what we've just talked about is called open market operations, right? Because they're just buying and selling bonds on the market, and they're just working on the market to manipulate the interest rates in the market. So those are called open market operations. The part of the Federal Reserve that met this past Wednesday, that was called the Open Market Operations Committee. Right, so it's a committee that decides on that. The Federal Reserve does have been doing other things though since the 2009 crisis and with the COVID crisis, because we're in weird times with the economy, right? Since 2009, the federal funds rate, except for a few years of like 2017, 2018, where the federal funds rate got a little bit above 1%, for the most part, it's been like really close to 0%. They've kept it at like a quarter of a percentage point. And so they're basically at the zero lower bound. They really can't go lower. Some European banks and Japanese banks have experimented with having the interest rates go negative, but that's not something the Federal Reserve has wanted to do. There's a fear that if interest rates go negative, that is, as the banks have their money on reserve at the Federal Reserve, it's slowly disappearing over time. That would be a negative interest rate, right? They're afraid if they did that, it would cause banks to go bankrupt, and that would cause greater financial crises. So we're stuck at the zero lower bound where the Federal Reserve can't make the interest rates go any lower, right? So that means that the Federal Reserve can't stimulate the economy anymore. Up until 2009, right, from 1980 to 2009, it was, oh, the economy is going bad. The Federal Reserve lowers the interest rates. That makes it stimulates the economy. The economy starts going better. Since 2009, the interest rate's been at zero. That is, the Federal Reserve has been doing basically everything that it can, and it hasn't been enough. So to give themselves some more tools, the Federal Reserve has given themselves some more tools. They started paying interest rates on the reserves. This is another tool that it gives an incentive for the banks to keep their money on reserves instead of like lending it out. And when the banks lend the money out, that stimulates the economy. So this is giving the Federal Reserve another tool to slow the economy down, right? There was fear that the Federal Reserve was doing so much to try to stimulate the economy in 2009, 2010. There's a fear that it's going to cause inflation. And so the Federal Reserve was like, well, in case that happens, we're giving ourselves another tool to try to slow the economy down, right? So that's another thing. And this is just simply the Federal Reserve just says what that interest rate that they're paying on the reserves is. I think it's been a quarter of a percentage point, very low interest rate. And they just print the money. They just add it to the spreadsheet and the money just comes into being, right? After 2009 crisis, they also conducted what they called quantitative easing, which is buying longer term bonds that have like 20, 30-year terms. And so they're trying to drive down the interest rates on those longer term bonds, trying to make the longer term interest rates go down. They're trying to squeeze the spread. Remember, I said before, spread is the difference between the low interest rates and the high interest rates. They're trying to make those long term interest rates get lower. There's a lot of debate on what the effect of this is. Just letting you know that's another thing that they did. And now during COVID crisis, the Federal Reserve has removed reserve requirements. So the banks don't have to keep any money on reserve. This is encouraging the banks just go out, lend money, right? If a business needs cash right now, the Federal Reserve is saying, go out, lend it. You don't have to keep any money on reserves. The Federal Reserve, normally those reserve requirements are there to make sure that we have confidence that the banks aren't going to fail. And right now the Federal Reserve is saying, don't worry about it. We're not going to let a bank fail. If a bank is failing, we're just going to give it a bunch of cash so that it doesn't fail, right? And so they're just doing this to try to stimulate the economy as much as they can during the crisis. And the Federal Reserve is also directly buying bonds from businesses. This is getting much more involved in the economy, right? So normally this would be a fear that this is the Federal Reserve picking and choosing winners and losers, but they've just been buying bonds from businesses to try to keep them from failing. So again, it's the Federal Reserve trying to respond to it. So these are some of the, given that these are weird times right now, some additional unusual tools that the Federal Reserve has been using. Remember that main tool, buying and selling bonds to control the federal funds rate, that is called the open market operations.